Hello, welcome to the Fuqua LinkedIn Live, and it's great to be back. And I'm very excited to actually introduce my book. So it's finally out. It came out last week, DeFi and the Future of Finance. And what I want to do today is to give you a bit of an overview of the idea that's in the book, but it's going to be brief. And what I'm really interested in are your questions. So I'd really like this to be a session where I answer or try to answer your questions. So let me talk about the motivation a little bit and the basic idea of decentralized finance. So we live in a system of centralized finance where we've got centralized commercial banks and brokers, insurance companies, central banks control the money supply. And that system has served us well for quite a long time. But it's remarkable to me that the system, in terms of the basic infrastructure, really hasn't changed that much in 100 years. So there's something new that is very disruptive, in my opinion. And we see already the first wave of disruption in terms of our financial system with the rise of fintech. So it's a lot easier to transfer small amounts of money and to pay today than it was like 10 years ago. However, and this is really important, the current fintech largely uses the legacy infrastructure. So they're hooked into the banking system. So you might use Apple Pay, but it is basically linked into the banking system. It's the same model where 3% is the standard fee for a credit card charge. So decentralized finance is fundamentally different. In decentralized finance, you interact directly with your peer. So there's no middle person. There is something in the middle, but it's an algorithm. So you interact with an algorithm. The algorithm doesn't really care who you are. So that's why I use the word peer. So you could be a retail customer, you could be a company or something like that. It doesn't really matter. Everybody's the same, and you interact directly via this algorithm. And the thesis in my book is that it's really not that hard to imagine a future where we're interacting with algorithms. And it's not just about DeFi, whether it's a self-driving car or something like that. It makes sense that we interact with algorithms. So the interesting thing is that these algorithms are not controlled by any one party. They're decentralized. So that's really important. And basically, this book is about a rebuild of our financial system, whether it's savings, whether it's lending, whether it's exchange, whether it's insurance. All of these aspects are essentially on the table to be reconstructed from the bottom up. So let me talk about the motivation for the reconstruction. And the talk today is supposed to be about DeFi risks and opportunities, and I'll sketch the opportunities and the risks definitely. So the current issues are number one, inefficiency. Uh, in my course, I show, and actually in the book, I show one of the first Western Union wire transfers from 1873. So 150 years old. The transfers for $300. And you can see handwritten the receipt. The fee, $9, 3%. How little has changed. The credit card swipe, 3%. You use Apple Pay? Well, Apple gets 0.5 and the credit card company gets 2.5, 3%. It's just an enormous fee. And it's really hard to justify, but it is justified by a number of things. So insecurity. So the credit card company, if your credit card is stolen, they're good for it. And all of the infrastructure that has to go into that. And basically all of the layer of middle people to make this work, the brick and mortar, all of this. And of course, the profit of the company. So you put that all together, it's 3%. So again, we've got a different system in decentralized finance where you interact with your peer. There's no spread in the traditional sense. There might be a small transaction fee, but there's nothing like what we've got in centralized finance. So there's many issues that I detail in my book. The second one is limited access. So in the US, we've got most of our population fully banked. But if you look around the world, 1.7 billion people are unbanked. And probably more are underbanked, including many in the US. And let me tell you why that's a problem. Suppose you're an entrepreneur, you've got a good idea. Maybe this idea could generate 25% rate of return. And you go to your bank and ask for a small loan. And the bank said, well, you're too small. We'd rather deal with one large company than 100 small companies. So you're a customer of the bank, so we're not going to lend you that money, but here's a credit card, and we'll bump the limit up, and you can borrow off of that. And you know what that means. That means that the rate on the credit card could be 24%, and the project's never pursued. So in my opinion, that is really costly for US economic growth or growth in any country. We actually need to pursue those projects that have 25% rate of return. We're stuck in this low growth mode of 2% real GDP growth. And Europe, 1%. Japan, 0. And I think one of the reasons for that are all of the frictions in our economy. And this is related to some of my academic research. So if you reduce those frictions, if you make it so that I could actually go out and borrow that money at a reasonable rate, then these projects are actually pursued. Indeed, if you think about the size of the government debt, there are basically 3 ways out. One is increased taxes, and that's not good for growth. Number 2 is to inflate, to print money to pay off that debt. And that's just like a tax, and that's definitely not good for growth. But the third method is to actually increase the rate of growth. And that is the most attractive one. So we really need to work on this. So number 3 issue is opacity. So when you deposit money at a bank, you don't really know the financial health of that bank. And you do know that the FDIC insures up to a certain limit. And effectively, we delegate to the FDIC the oversight of our financial system, our banking system. And their record is checkered, to say the least. In decentralized finance, everything is open. You can see the details of the algorithm. You can see the balances. So you know if somebody's paying you, whether they have the money or not. It's completely transparent. It's kind of obvious in decentralized finance that there's no centralized control. our system today has centralized control where the bank can actually freeze your funds. The government has great control over various things also. In decentralized finance, you are the one that controls your wallet or your account. And then the last problem with the financial system today is the lack of interoperability. So this is the idea that it takes a long time to go, let's say, to transfer money from your bank to your broker or vice versa. Uh, in DeFi, uh, it is a system that is built to be interoperable. So different protocols interact with different protocols and in a seamless way. So you send a transaction that the transaction might have many different steps from one protocol to another, and it's completely seamless. So a lot of advantages to decentralized finance, but I do want to emphasize before I take some questions that there are definite risks. Okay, so the book is not about a guide to trading Bitcoin or anything like that. Indeed, Bitcoin is not really prominent in my book because decentralized finance, you need to interact with algorithms in a blockchain, and that's impossible today with the Bitcoin blockchain. Bitcoin actually shows up in a tokenized form on the Ethereum blockchain. So it is used, but it's called wrapped Bitcoin, and it's an Ethereum token. But let's talk briefly about the risks, and they're numerous. And my book ends with these risks in a full discussion of them. And one kind of obvious risk is the algorithms. And these algorithms I've already mentioned are completely open for anybody to see. So I argue that this is like a new attack vector for hackers. If you think about a hacker, let's say, trying to get into, let's say, the computer systems of Target, that's actually hard to do, to get in. So once you're in, you need to figure out, the code and where the databases are and things like that. But with these smart contracts or algorithms, everything's open. So you get to see it and dissect it and try to figure out the vulnerabilities. So smart contract risk is significant. There's other things that are important, for example, scaling. So for example, Ethereum maybe can do 20 transactions per second. Visa can do 75,000. And obviously, 20 transactions per second is not a technology that's viable in the future. And everybody actually knows that in the Ethereum space. And that's why there's many different initiatives that are focused on actually increasing that throughput. And we will see that happen over the next year. People talk about the environmental issues. So both Bitcoin and Ethereum use a technology that essentially is environmentally reckless. So Bitcoin alone uses the same amount of electricity as the country of Argentina. So Ethereum, where DeFi resides, will actually move to a different technology. So they will abandon the so-called proof of work and use to a different technology that's much more energy efficient. So that risk will be mitigated next year for Ethereum. For Bitcoin, I doubt that they can ever change their approach. Ethereum is much more flexible. There's obviously regulatory risk involved here. This is a new space. The Securities Act of 1933 doesn't include any reference to cryptocurrency. So there's always issues here. But the regulators, I think, understand the big picture that if they're too harsh, then the technology just moves offshore. If they're too lenient, then people will be taken advantage of. Like in the end, this is a disruptive new technology, and it's not without risk. If you look at any technological disruption historically, there's always risk associated with it. But one thing I will say is that we're less than 1% into this disruption. And it's actually a good time to get in, given that we're so early. And in my vision of the future, the world becomes much more efficient. Uh, Algorithms are doing things that we do more manually today. And I think that there is a robust future for decentralized finance or DeFi. However, there will be ups and downs. And you need to be careful that given that we've seen the ups and the downs many times already in the short history, that you need to expect that. And it's a real mistake to abandon the space after one of the drawdowns. So at this point, I'll take questions. So the first question is about the role of crypto brokers like Coinbase. So Coinbase is a great success, and most of you probably know that this was an early stage investment that the Duke Endowment made. So this is a great success. It's been in the media about that. Coinbase is a broker, a centralized broker. So Coinbase has played a very important role. And I've featured speakers from Coinbase. My students have Coinbase accounts, but they're a centralized broker. They deal in many decentralized tokens. So I call them CDeFi, so CEDEFI. Okay, so the main challenge to Coinbase and Binance and these other exchanges is decentralized exchange. And we call that DEX, DEX. And with DEX, instead of using your traditional broker like Coinbase and all of the spreads that are associated with that, you trade directly with an algorithm. So you send some token, like one token, to an algorithm, and then the algorithm sends back another token. And the algorithm is available 24/7. The fees are very small, and it's completely transparent. You can see the liquidity that the algorithm actually controls. So the contract address is available for anybody to see. So that is the challenge to the centralized exchanges. And there are over 10,000 centralized exchanges that deal with crypto in the world right now. But again, in my opinion, they will be disrupted by the decentralized exchange. So a good question. So there's a question on that investing in any cryptocurrency is no different than gambling. Well, you can make the same argument for stocks, right? They're risky. They could go to zero. So, of course, there is an element of speculation, but I want to emphasize that the media really focuses on Bitcoin and its ups and downs and stuff like that, and people using it for speculation. And much of the business in the space is driven by the speculators. And again, I think that a couple of things are important. Number one, you can't ignore this space. There's $2 trillion in capitalization. So it's really hard to ignore. So you can make a reasonable case that some crypto should be in your portfolio. Number two, you shouldn't do anything undiversified. So you shouldn't take 100% of your pension and put it in Bitcoin. That doesn't make any sense. And then there's a second level to diversification. This is not just about Bitcoin. Okay, so there's many other uh, tokens that you can invest in, including tokens that are linked to decentralized finance protocols, so-called governance tokens. So you need to have a portfolio like that. And number three, and this is really important, you need to understand what you're investing in. So you buy some stock of Apple, you know their business. You've got an iPhone, you use iTunes. You need to do the same thing here. So before you actually invest, take the effort to actually try to understand what's happening. Okay, so there's an issue about the hackers, the so-called black hats. Look, again, given that all these contracts are open source, you're going to have people coming in and exploiting weaknesses. There was an interesting one the other week with Poly, where $610 million was drained out um, by a hacker. They asked for it back, and they got it back, and they gave the hacker a bug bounty. And it was really interesting. The motivation of the hacker wasn't to steal, but the hacker actually saw a vulnerability and made the decision, well, should I take the 610 or leave it for somebody else? So again, it just really stresses the importance of having an algorithm that is rock solid. There are many companies in the space that do audits, and you need to be audited. Um, so Yeah. So, are there significant risks with these algorithms? And I discuss, and this is from a current student, Renisha. So, I discuss the different types of contracts. There's some contracts you put them out there, and that's it. You can't change anything. In decentralized finance, many of the parameters in the contracts can be altered. For example, collateralization ratios and things like that. And the governance has control over these key parameters. The governance is strongly incented to do the right thing. So there's a governance token that they've got. And if they do the wrong thing, if they increase fees or maybe send money to themselves, if they do that, then people just abandon the protocol. And one interesting aspect here is that given everything's open source, that you can just grab the code and make a change, and you're up and running in a day. So you can have a successful protocol. Somebody comes up with a change that makes the user experience a better experience. They take the old code, they bolt on a few lines of code, and you've got a new protocol. And this is a very powerful idea. If you can imagine in, for example, traditional banking, that somebody's got an idea to make the interface a little more efficient or user-friendly, how long would that take to actually happen at one of these large banks? And many of these banks are sitting on millions of lines of legacy code. It's a nightmare. This can happen very quickly in this space. Yeah, so there's a question about social decentralized finance. And yes, there's many aspects of this, and some of these aspects I talk about in my book. I talk about more of them in my course in terms of the social aspects here, and in particular, the space again is pretty early. But there are already initiatives where people can basically group together and provide collateral for a certain cause. There are many possibilities here. So we've had things like in fintech, like crowdfunding, but that's really expensive. So it's 10%. That's the fee. So it isn't 3%. It's 10% fee. So with decentralized finance, the fee could be like close to zero. There's a small transaction fee, and that's about it. So there's many possibilities here with this technology, and it actually goes well beyond decentralized finance. Blockchain technology allows for competition for like various things that we just take as given, like social media. Decentralized social media is a big deal right now. Identity. All of this is possible. The key thing is everybody is treated equally. It doesn't matter if you're a billionaire or just have $50, you are treated equally in this space. There is a question about permissioned DeFi. So this is a complex issue. And essentially, given again, this is a regulatory issue in one respect. You don't want people transferring money illegally, and there's know your customer and anti-money laundering regulations that are available, that are enforced in the U.S. So you can actually embrace the decentralized finance protocols. But if you're a retailer, you need to know your customer, right? That's on you. And we see, so think of the decentralized finance as providing this infrastructure. The other thing is that given the nature of blockchain technology, the ledger of every single transaction is public for anybody to see. So I think that a lot of the illegal activity that used Bitcoin and Ethereum early on, they've kind of figured out that, having all our transactions in a public record that nobody can alter, well, that's a really bad idea. So most of the illegal stuff that happens is with cash. So cash is truly anonymous. Bitcoin and Ethereum, it might be anonymous. You can send to an address, but then once you've got it, you have to do something with the token, and that's where you're discovered. So there are anonymous cryptos, and that's an issue, and policymakers will have to deal with that. And it's not just an issue of decentralized finance. This is an issue where people communicate securely, or send texts or video securely. So this is a bigger issue for society to deal with. So there's a question from Kyle, a current student, about what will it take for corporations to adopt this? Well, again, it's early. And I think that they just need to be demonstrated how much they can save, right? So instead of using the legacy bank, so I did this wire transfer in euros to Europe last week, and my bank said, "Oh, you're a great customer. We're going to waive the fee." So I said, "Oh, okay." And then they quoted the rate, and the rate they quoted was 2.5% off the market rate. And I said, "Is that the best you can do? I'm a good customer." That's the best they could do. So again, this is just an example, 2.5%, 3%. Again, nothing really has changed, and companies will be convinced by the cost savings. Right now, it is still a bit clunky. And also, companies initially were worried about custody, and that's why very few investment funds actually hold crypto, because they didn't know how to treat the custody of the private keys. But now we've got plenty of custodians, whether it's Coinbase Pro or Fidelity, that are willing to hold the keys if you're nervous about that. For individuals, you can just hold your own keys. It's not a big deal. It's like having cash in your wallet. Let's see, I've got time for maybe one more question. Um, so it's actually two questions I see here. One is about countries banning cryptocurrencies, and the other has to do with how do we think of valuation. So it is true that some countries have realized that they're behind and they need to do something. And this is the idea of central bank digital currencies. That technology is completely centralized, and there's many disadvantages, including the government potentially knowing every single transaction that you do. So I believe that many countries are playing catch up. They see the threat. Think of Venezuela. This is a great example. A country in hyperinflation. If you're rich, it's no big deal because you have a bank account in Miami or somewhere, US dollar bank account. But the rest of the population is facing 700% inflation. That's devastating. So with this technology, the other part of the population can have a US dollar bank account. It's really easy. You have a mobile phone and you load in some US dollar backed token like USDC. So you're hedged. And then if you think about it, you've got effectively your population abandoning your currency and using these tokens. So you disintermediate the central bank. And I think we'll see that. We'll see that outside of the U.S. The U.S. dollar still is kind of the reserve currency of the world for now. And I want to underline, like, for now, because in my vision of the future, basically everything is tokenized. So I've got a wallet that has got maybe some US dollar token, maybe some euros, maybe some gold, maybe some IBM stock. I've got many different things. And then I go to buy something from you, and I can choose what I want to pay with. And if you are not interested in what I'm offering, then very seamlessly, we go to a decentralized exchange and I trade what I want to use to pay for something that you want to receive. It happens automatically. And what I'm talking about, and it's kind of shocking, is barter. So this technology enables efficient barter. And if you think about that, it's kind of a deep idea. Where is the future going? And the central banks, I think they've already lost control of the money supply. I think they realize it. And these cryptos are an existential threat, and they will try to delay. But this is a global phenomenon. It's easy to move offshore. And if there's an algorithm out there that's set in stone, what are you going to do? You can't shut it down because there's nobody that can do that, because the ledger is shared. Tens of thousands of copies of the ledger around the world. So I think that the horse has left the barn. It's too late. And the central banks will try to delay, try to adopt some of the more efficient things, but we will be living in a world of multiple currencies, multiple tokens, and I think that's a good thing. So at this point, I've gone a few minutes late, and thank you for all these high-quality questions. We'll try to capture the questions, and I'll try to get back to you on that. But I will sign off. But let me tell you, in 2 weeks, we've got an excellent LinkedIn Live with Daniel Gross, a new faculty member, relatively new faculty member. And I saw his talk in the summer, and what he's going to talk about is crisis innovation. And you should definitely tune in for that.